Hi, welcome to this video update from this morning's market alert for Thursday, the 11th of February 2016. Right, this morning we see the Dow has dropped over 250 points from the high. And what is the reason for this? Well, the answer is quite simple, actually. In this morning's earlier edition of the market alert, I spoke about Deutsche Bank and the problems that they've had, and also the share price. Well, this morning, and I've recorded the last couple of hours for you using the internet just to pull this information, and if I just fast forward through, you'll see that both Deutsche Bank and Barclays have moved sharply lower this morning. You can see their prices dropping 6% respectively on both of these banks. So you're probably asking the question, why the relationship between the two banks? Well, if we do a bit of research, we'll just start off with the current price. Just see where we are. We're down 6.86% now for Deutsche Bank, and Barclays now below the 150, which is a crucial level. So what's the relationship between the two? Well, on Monday, Barclays Bank suspended trading in their own shares, and after a bit of research, the Daily Telegraph actually reported this. You can see the headline there: Barclays shares suspended as market slumps. They cite all sorts of other reasons, but that's not the important bit. The important bit is down here. See, Barclays has traditionally been seen as a UK proxy for Deutsche Bank. In history, it has had similar characteristics with an investment bank and capital ratios which are weaker than its domestic peers, said Ian Gordon from Investec. Barclays has a high degree of international connectivity than the other UK banks. So on a day when European banks credit default swap spreads, a measure which tracks perceived levels of risk, are going through the roof, they would be a bank exposed to contagion and counterparty risks. And it's the counterparty risks that's the interesting bit. If you do a bit of research and go back in history, you will find that in 1998, Barclays Bank was involved in what was a company called Long-Term Capital, and Long-Term Capital was bailed out by the Federal Reserve to the tune of $3.5 billion. This is one that's been buried and not, if you weren't trading at the time, you wouldn't be aware of. But as it says here, after losing $335 million in 2 weeks on proprietary trades related to the ruble, SocGen, IGN, USB made cuts too. Barclays then chief executive Martin Taylor resigned in November. 4 senior UBS executives resigned in October over losses related to long-term capital. So Barclays has a history of counterparty risks and being involved in derivatives as well, and highly speculative areas of investment as well. Let's have a look at the background of Deutsche Bank, and this is a Zero Edge article from the 13th of June this year, when they were already predicting there was going to be a problem with Deutsche Bank. The headline there is Deutsche Bank, the next Lehman. Well, if we scroll down, you'll see what the article is about. Now, it's the derivatives markets that's the problem. Derivatives are gambling instruments that all central bankers hate, but they allow the banks to actually trade in. They are gambling instruments effectively. It's a zero-sum game. You speculate on the direction of a certain commodity, interest rate, currency, commodity, whatever, and somebody else takes the other side of the deal. So one wins, one loses. But the problem we've got here is that Deutsche Bank are exposed for a total of $54 trillion, euros at the moment in their portfolio. And the problem is, of course, is the knock-on effect to Barclays, which is why you're seeing the situation here where Barclays is tracking Deutsche Bank at the moment. And that's the reason why, because at the moment, as they tried to do on Monday, they suspended trading in Barclays for 8 minutes. And that's not a good idea, because now the hounds can actually smell the blood, and they're selling Barclays quite strongly on the basis that they may be involved, as the other article said, the counterparty risk with Deutsche Bank. And Deutsche Bank are currently exposed to, as I say, they're 54 trillion. They haven't got that in assets to pay, and if Barclays is involved, they're not going to get anything out of it, because the Deutsche Bank, won't have the money to actually cover it. So they both lose. So the zero-sum game becomes zero profit for both. What is to happen, I don't know, but you can take no notice of the the rhetoric from the German finance minister and bank chief insists Deutsche is rock solid. We've heard all this before with Lloyds, RBS and Northern Rock in 2008. It all starts to sound the same, feel the same, and the usual rhetoric. And as I said in Tuesday's market alert, as Claude Coburn once said, don't believe a word until it's officially denied. Now it's being officially denied that there isn't a problem, everything's fine, and the share price is saying something completely different. So again, just watch out for this. And really, I'll finish off with this. This is a good old cartoon here. Let's get out of here, me first, and that won't be the first time either. So if we go to the end of this, it's interesting to see that meet Tom Humphrey. He heads up Deutsche Bank investment banking operations on Wall Street. He was also the head of fixed income at Lehman. So we know what happened to Lehman. And here's the final word on this video. History never repeats, but it does rhyme. In market terms, it tends to rhyme just about every 7 years. And guess where we are? We're just entering into the 8th year. So again, this is not to create any panic, hysteria. It's just to bring to your attention why the market's down 200 points this morning, purely and simply because the market doesn't believe the rhetoric from the German finance minister or the CEO of Deutsche Bank. And Barclays is moving lower and shares suspended on Monday because they are in a way the UK proxy for the Deutsche Bank, as it says in the Daily Telegraph, not my words. So there is an issue in the background there that you should be aware of. That's all. Nothing may come of it, but at the moment, like I say, the market's moving lower because of it, unless they can actually show in concrete terms that there is a way out of this, then that will be fine. In fact, there was one thing I wanted to leave you with, which has disappeared off the page. Let me just find again. Here we go. It's actually here. This was out on the 10th of February. Deutsche Bank shares saw 11% on bond buyback. So if you read that, you tend to think, okay, so fine, 11% on bond buyback. Well, first, there's a problem with this bit. Bond buyback. If a bank's buying back its own bonds, it's got a problem. And then this is the important bit. It was just speculative. It wasn't actually proven that they were actually doing this. So it helped just to bring the shares back up 11%, but this morning they're down 7%, and currently, if we have a look at Deutsche Bank, now down 7% at 13.56 euros, and Barclays have broken that magical 150, been down to 148. It's actually coming up a bit there, but if you have a look at the 5-year low for Barclays, you can see we're at a crucial area. The max, we down at 2008 levels, 51p per share there. At the moment, we're down at the 2011 area for this market, heading in that sort of direction. So no issue at the moment, but it's again just something you want to keep in the background at the moment, why this is actually going on. Right, that's it for me. Deutsche Bank again down 7.17. Now you can see it's on a bit of a slide this morning. Again, if you have a look at the 5-year chart, you'll see we're below the 2012-2011, and on the max, we're actually taking out the 2008. So there is a problem with Deutsche Bank, whichever way you slice it, according to those in the know. Otherwise, the share price wouldn't be down, making new historic lows. That's it from me. More tomorrow or another report during the day if anything else unfolds, but that's why you're seeing the market down in the pre-market session for the Dow.